Hello, good evening. Welcome to the live webinar this evening. My name's Michael Baker. We're going to be looking at the virus, how its effect is on the markets. If you could just let me know you can hear me, just type something on your keyboard. Hello, Craig. Hello, guys. Thanks for coming along. Kojo can hear me. Remco, good to go. Mark, Roger, Lisa, Liam, Mario, all good. No picture. Has everyone else got a picture? I can see what you guys should see. Should see the little splash screen. All good. So yeah, I think we've got picture for a lot of other guys. Picture fine. All right, we've got a bit of just a mixed bag there. I'm sure it will come through with the as I start rolling through the presentation. I was planning a kind of a semi-long one today, but because of what the markets are going on and sort of ETX's arrangements at the moment with myself, I need to we'll do a more of a simplified one, okay? And I know it deserves so much. Yeah, you can only see the title page. I haven't changed the page yet, guys. It deserves so much more of this subject, but to take traders away from their screens at the moment for what's going on, this is a once. I mean, I've traded through the financial crisis. I've never seen anything like this before. It's it really is something else. So we'll just go through it now, and yeah, I'll have you straight back to your screens. Before I do crack on with the presentation, if you could just take a look at the disclaimer, have a little read through that, and I'll be back with you shortly to continue. Right, let's get to it. I mean, this has really come on very strong and taken a lot of well, taking the market certainly by surprise. What I seem to be using is there's a Johns Hopkins University tracker, which seems to be the tool being used by a lot of trading desks, financial institutions to produce their sort of information. They seem to be providing sort of the up-to-date sort of stuff. This is actually from their website now, just showing you where this is affected and what the actual, outbreak looks like. It just looks like a lot of red dots, but that just shows just where this has got now around the world, and it's pretty clear it's what it is, a pandemic, and now all central banks, all governments are now putting into measure nows to really dampen the effect rather than try and contain it. I mean, it seems now that it's going to really have a huge effect on the financial markets, and you can see that from where we're trading at the moment and the volatility we're seeing. And it's just over the sort of coming days, coming weeks, when we where we're it's just over coming days, where we are at the moment. We're still, I mean, it might not look like it's a huge thing at the moment, but when we've really only gone into sort of lockdown mode in sort of London and places like that, what kind of effect that's going to have on things going forward. But all markets are under serious strain at the moment, a serious amount of volatility, and as you can see from your platforms, it's moving very quickly one direction and then the other. If you're a volatility trader, if it's if it's what you trade, then you've got plenty of that in plenty of markets. We'll cover sort of a few now. But just to show you now, look, this is the outbreak. It's got more than that today. I've not really managed to do an update from today, but I know it's gone past the 200,000 mark. What the only good, well, the only positive really from that is China started to slow down, but we're a bit confused with the numbers from China at the moment. So they're still being looked at quite intensely, but Italy numbers, Spain, Iran, Italy numbers, Spain numbers, Germany numbers, and even UK numbers are continuing, and the US numbers are just starting to fly up at the moment. They really are. There's fears with the UK now. In London particularly, you could start seeing a doubling, and it's really that what kind of trajectory UK are on that's going to get an idea really where we're going to head. Okay, so it's really looking at what that trajectory is. Is it going to start doubling every 5 days? Things like that. What kind of measures are coming into place now to really soften this blow to the economy as much as it can, and that you're already seeing central banks sort of step in and really 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 trying to delay things and just make sure we just don't have too much of a big hit. This is a sort of trajectory chart there. That's not really come up too clear there, but it does show where countries are at the moment. You sort of got your Denmark, Greece on your doubling, and then you've got sort of the UK doubling every 3 days at the moment. It's they sort of charts that markets are looking at. They're sort of taking those into consideration to see just where we're going to head. But the numbers are worse than what the sort of government have expected and what they thought was coming out. Well, didn't underestimate it. Well, I suppose they did underestimate it, but it was too much to call for what's actually happened, what's actually come out. And that's why you're seeing markets around the world tumbling and huge amounts of volatility. And if we start to look at sort of markets such as Wall Street, I mean, Wall Street is the most volatile one, isn't it? They're all moving extensively, but this one is what gets the headlines. Wall Street. We've seen, if you stick it on a sort of a 4-hour chart there, you've seen quite a strong sell-off down there from nearly the 30,000. I think we're 29,500, and we've gone below the 20,000 today, as low as 19.5. That's a huge astronomical sell-off. It's off nearly 35%. And a lot of guys, I mean, a lot of early traders who are watching this were thinking, okay, well, indices over the last 4 or 5 years, due to this sort of QE that we were getting and central bank intervention, that was holding up index stock share prices and keep pushing it up and up. That was central bank intervention, almost like a bubble, and it just had to take for something to burst for that all to come tumbling down. And yeah, I think we've got that now, and it just kept moving and moving. So your real opportunity, real sale was to be short when we start to see those gap downs, which you did on the daily charts. You saw huge gaps downs, and then you thought, oh, wait a minute, this is things aren't looking too good here, and it's just continued to tumble and tumble. It's just if you are selling near the lows here, and the bounces you're seeing on here, it does bounce 1,000, 2,000 pips at a time before we see markets start to sort of drive south again. But if you're not looking at Wall Street at the moment as a sort of a trader, as a speculator, that's the main sort of markets we're looking at. But it is moving incredibly large amounts very quickly. So having your risk nailed on for for trading this particular market is imperative, because if you get this wrong, and you've got some size on, or you got whatever size you got on, that can move very quickly against you as well. It can move in your favor, but it's so important now just to keep an eye on things, and make sure you've tied up, you've done your basics there, you've done your risks, and you're on top of that, because these sort of moves in a day, though, you could it can it cannot be pretty sometimes, but volatility and these sort of things is what we look for. So you've got plenty of it, and there's going to be plenty more opportunities. So it's really just sometimes keeping your powder dry as well, saving yourself, saving your confidence for another move, because if you miss out on something, there's no fear of missing out at the moment, because as I'm going to show you in a bit about the ranges and stuff, it's here. It looks like it's here to stay for the foreseeable future, because we really just don't know what these effects are. What these effects are at the moment, because these are so early days. I mean, we've only seen that 350 billion yesterday from the Chancellor. London, we're based in the city ETX. It's on complete lockdown at the moment. All companies are shutting down, buildings are shutting down. My cycle into work, or my tube into work, is it's pretty quiet out there, because people are really taking on board what government advice is, and to to really to isolate themselves, or to work from home, just into we sort of scatter this virus, which by the sounds of things is spreading. It's going to spread to most people, so it's about sort of scattering it, and make sure they're freeing up sort of our health service to cope with what they're predicting that is coming along. Let's have a look as well. SP 500 here, again, huge sell-off there, off 32.5%. So you got both SP 500, Wall Street, two of the biggest markets in the world, off nearly 40%. It's if you're Warren Buffett at the moment, who says he just sits on his hands and waits for a crisis, and then hoovers up stuff that's cheap, I'm sure there's going to be a lot of investors out there, but just trying to get that sort of low as well. How much more further is it going to get? I mean, I'm looking at the markets now. I've had a little bit of a bounce from the low, but still just tracking those lows there. Nothing too special. No too special bounces there. So this could get even more worse over the next few days. Just got to keep an eye on things there. Again, there, UK 100. Again, huge sell-off there, was up by 7,500, 7,000. Yeah, not good for my ISA tracker, I think, which is tracking a lot of markets here. That's taking a bit of a hit. That's off now to where are we trading at the moment? UK 100 down to the 5,000 level. I mean, who thought we would see that 5,000 level? It's here, it's there, it's trading. It's very volatile. We've seen quite big bounces in the FTSE, and you've seen quite a bit of volume in the FTSE as well. It's quite bid and offered there, so that's why we still got quite sort of tight, good spreads on the UK 100 there. So low index point, and it's well bid, well offered on the markets there. So we're still seeing good sort of market conditions, a good solid underline there, which means that with the spreads are remaining pretty tight on UK 100, and the other ones are the higher sort of points you are seeing a little bit more extended spreads, but it's only representing what's going on the underlying there. If you have a look at sort of what's going on in your futures and things like that, they are super wide spread, super amounts of volatility, huge tops going, huge buys going through sells. It's just that's what these markets are following, and that's why we've got some some widened spreads there. But these markets are moving. You're still seeing sort of huge bounces here and there. There's still untold opportunity, and for the foreseeable as well. I mean, how long did the financial crisis, when that first started to get, that was when the Lehman's, I think it was before Lehman's, we started to see some signals going off there, and that went on for a huge amount of time of volatility. So now's your time just to like I said, keep on top of things, keep on top of your charts. Like I said, you're not going to miss. You miss out one opportunity, there's going to be another 100 that day. So no point doing sort of, taking on huge amounts of risks or serious sort of amount of damage, because you've got a lot more opportunities now and it's going to be coming day by day. You're going to be, having these limit downs, these limit ups, things like that. And as when overnight markets close, and you're going to be gap downs, gaps up. It's this all. We're going to see all this now over the coming weeks, months. Germany 30 were there as well. Again, huge sell-off there. We're trading up by 13.8, nearly 14,000. That's dropped down to 8,212 there. I think it's a bit lower today. We went down. Yeah, we went around the 8,200 again today. So again, that's probably one of the hardest hit in Europe. 40%, 40% off. It really is incredible, really is amazing just what's happened to these index markets, and they're your sort of main markets at the moment. They're your main sort of volatility. We are seeing huge amounts of support for the dollar as well. Cable, if you've not even taken a look at cable is trading. It went down as low as 1.14 and a half. 1.14 it's trading. That's that is a huge. That's off nearly 2,000 points since the general election was last from December when we had that little spike up. It's seen a huge amount, and not as hard hit as the euro. It's down to its sort of yearly lows that we've seen. After seeing quite a lot of buying, but again, that's it's not hasn't been as hit as much as that cable there. That's really tanked, and I think that's just really taking that trajectory into consideration. This huge plan that's been announced by the government, that's a huge amount of debt. I know that's going to be put onto most business owners, but that's huge amounts of risks that the UK government are taking. But I think they think possibly we may be looking at an Italy situation here if we can't get things under control. And with just how London, how business connected, how internationally connected it is, that's what they're fearing now, and that's probably why you're seeing the pound trading so low against the dollar, the pound trading so low against the euro. It's we really have tanked there. So what we're actually seeing now is what's concerning, what's actually spooking markets. Now, we saw coordinated action from the banks, but we saw that back in the financial crisis, the first time we've ever seen coordinated action that actually drove markets to the skies when that actually happened before, because that we can't, the markets kind of looked at support. Yeah, brilliant, that's it, great. But then if you all this support, there must be something seriously wrong, and that's really how these markets have taken it now. They just know that there could be some big trouble laying ahead. So what we saw from central banks this week, we saw the Fed, they've cut their rates to almost zero. All that sort of rate hikes we saw, that quick cycle, it's all been undone very, very quickly, all the way back down to zero. So the Fed futures fund rate down to nearly zero, and they've relaunched their QE. So £700 billion stimulus program. A lot more talk now of further stimulus. Even with stimulus now, that's dollar's still going through the roof. That really is your safe haven. They feel, and that's really where you get a lot of volatility as well. Interest rates from the Bank of England have been cut at half a point to 0.25. They stand on the ground ready to do some more action. Andrew Bailey, he's the new governor. He's come out today and said, he just doesn't see the benefits of going to negative interest rates, but there's still an option. Something's got to be expected here from these guys from the Bank of England, because this cable has, it's really fallen out of bed there. And ECB, they've announced 120 billion pound expansion. They couldn't really do too much more of. Hello. Okay, just do a quick mic check. Yep. Okay. Cool. Mic check, everyone. Can everyone hear me? Yeah. Perfect. Right, so ECB couldn't really do too much with their rates, because they're pretty much, and they've actually got a negative deposit rate already. They're coming for 120 billion pound expansion. So this is all going into the markets. Usually this sort of activity gets a lot of interest. It's to support the markets, but I think they're just fearing the worst at the moment. They really are. They are seeing huge amounts of selling, any huge amounts of buying. Whatever sort of strategy you have, you've got to think like a trader at the moment, who trying to get on top of the volatility, you know, whether you be sort of you're in, you're out catching the bounces, and you know, making sure that your downside isn't, you know, a huge amount where it takes you out of these opportunities or damages your confidence. Is really what a trader should be looking at now. That's what you be thinking, and don't be worried about missing out. I keep saying that. Don't worry about missing stuff, because I've never seen anything like this before, and I traded through the financial crisis. This is like your next. This is one of your, you know, huge events that come every 4, 5, 6 years. You know, so it's one of those things where you sit on your hands and you wait for. You do your sort of daily sort of trading, your bread and butter with your technicals, but now, you know, technicals will be blown out the water now with all this. You know, it's just um, it's really is it's huge. And you know, yeah, market conditions, of course, spreads to widen, but no, these markets are moving hugely in one direction, the other. A lot of volatility, plenty of opportunities. You know, it's, you know, really is. They really are, you know, thick and fast all day, night, all night long. Government responses. Uh, 850 billion pound economic emergency economic stimulus now. These are from the tax cuts and things like that from the US. 330 billion. We saw that yesterday. That's from our new chancellor. He announced that. I mean, what a start to his job and Boris's job, having to come in and deal with this. And then Germany have announced a fiscal aid package as well. So the governments are doing their bits. Central banks are doing their bits, you know, and that's what's causing all this volatility, and you know, investors are panicking and selling out at the moment. So it really is a case of you know, just watching the markets, watching the news, keeping on top of things, you know, and just seeing if you can spot sort of you know, those bounces from the lows, or you know, I've got another tool. I'm going to show you a few tools that traders will use to place on the markets. But you know, it is a case of, you know, possibly taking these down to shorter time frames, you know, because you know, you can see a lot of, if you're just trading sort of the daily on these sort of swing trades, you know, it's sometimes hard to sort of take advantage of that volatility that we're seeing sort of throughout the day. Trading, okay, so this is sort of what I've been looking at, what I've been thinking when you know, with these just extreme market volatility. You're seeing the most volatility you've seen for a very, very long time. It is, I mean, the VIX has gone through the roof. It technically, it looks like it could break out further as well, the VIX. It's staying up there as well. So huge amounts of huge amounts of movement in markets causing that VIX to sort of ramp higher. Huge price swings, so do notice that as well. If you are trading, you start going offside, you know, think it's okay. Usually you use an average true range or something like that, which looks at the range. But the average daily range now for the Wall Street is 1,606 points. Okay, since the 24th of Feb, every day 1,000, and then before that it was only 364 points. So average trade range for Wall Street is, you know, 1,606. It's and that's just, you know, that's what, a fourfold increase. You know, it's just a fivefold increase. It's just, you know, just got to take that into consideration. You know, that there is a lot of movement in the day now. You know, so if you are sort of trading and it's going against you, and you got to look at your ranges there and think, okay, well, on average going 1,600, you know, can I afford to take that sort of hit or let it go that far, not based on that sort of ranges? So that's something to consider as well, especially with the Wall Street, just how much that's moving, and just, you know, how much more sort of opportunity there's going to be throughout the day with those sort of moves. I mean, we're off nearly 2,000 points from yesterday's close, nearly 10% on Wall Street at the moment. So that's just incredible, isn't it? I mean, every day I'm looking at it's usually more down, but 1,000, 2,000 little bounce. But it really is extreme market conditions at the moment. One thing as well has been looking at is this limit up, limit down sort of stuff. I mean, it's all probably going to be new to you guys, but you know, a lot of prices are based from the futures, CME futures, and then from there you can derive the sort of the cash price. If these markets do close, so CME do close their markets, and then ours will close as well, and that's why you see on your chart it kind of just Okay, just so I was just listening to some emergency ECB news. Okay, so ECB are doing an emergency call on the virus response at the moment, so expect some news imminent. Um, so yeah, so limit up, limit down is overnight sort of trading. There's a 5% sort of swing, which will the breaker, well the breakers will come in, whatever you want to call them, and then that's suspended till till the market opens at 1:30. That will change at 2:30. I think, is it next week? I think when do we spring forward? Is it on this Saturday, I believe? When we spring forward, that will change to um, 2:30. So be on top of that, and then you'll have an extra 2%, and then 13 and 20% before the other breakers come in. And once they break in, markets are closed. They're closed for trading. That's how trading works. It will close up, and then they'll reopen again once the breakers come up. A 20% downside. We haven't seen a 20% downside yet. That actually suspends it for 24 hours. So markets close for 24 hours. So we're not really experienced that, but we've seen a lot of limit ups and a lot of limit downs lately. So do take that in consideration when you are trading, because you're in the same position as everyone else. When trading is suspended, it's suspended. Yeah, when it won't allow any more sort of selling, it's not going to let you do any more selling, right? You can yeah. So if you are, if that's the market, you can't sell because there'll be, and when it's limit down, there'll be millions and millions and millions of sort of contracts building up, to push it down even further. You don't have those sort of breakers on sort of on European products, sort of Eurex or Life. It was just on the US at the moment, but you can get a good idea where sort of the US will reopen by looking at the percentage difference from when it did go into limit down to where sort of the Germany 30 or the UK 100 is trading. But that's a little thing, but these markets are hugely driven by the US. So once they open it, they take full control, and they'll start to sort of find where their value is, where they should be trading that particular time. Of course, spreads. We spoke about spreads already. Even though spreads are widening, they're representing underlying markets. Conditions are very volatile at the moment, and we are seeing. Sometimes we feel we're seeing sort of volume come back in and a bit of normality, but doesn't last very long, and it markets start to sort of push out again. But we will look to get those sort of those down to down to sort of normality when by looking at the when we get the underlying sort of back to normal. Also, again, weekend positions. These positions do look, because you're getting huge gaps when you do have the weekend. The difference in opening between sort of Sunday night and Friday close is quite, it can be quite extreme as well. And you're taking positions over there. That's risk as well. So do factor that into your trading. Do keep on top of that as well, because it's hard to see really what happens over the weekend. It feels for me, actually, when I get to the weekend, it's just a bit of peace and quiet. Going through all this all week, and then all the news, keeping up to the news, and then on weekend I get nice be quiet. And then Sunday night it's back to hands on deck. But when you are sort of when we are looking at, so we got the chart there, these bounces here, these extreme sort of bounces, these are like 1,000, 2,000 pip sort of bounces. So if you are sort of in positions and you do sort of catch a bounce, do think to yourself, okay, well, look, any sort of markets, you are getting quite nice bounces, so sort of snapping at profits and things like that. Are you going to please repeat? Sorry, someone's asked. Please repeat the dates for the limit up down breakers. They're every day. So 5%, 7%, 13, 20%. So they look at the previous close and they look at if the swings from the previous close. Their breakers are every day. So you expect them every day for the foreseeable future. Expect them every day, and then expect some sort of. It may even come to on US markets. Yeah, so the breakers are only for US markets. If you've not seen if you have a look at the US markets, they kind of stop trading like I've got here. See this limit down here? Let's see, that's there. There's one there as well as a limit up. Yeah, so it's come down, limit down, close for a day. Usually you'd have bounce, you could have bounces back up from the limit down, but the sellers were so confident it should be lower, so they built up and they held ready for it to open again, and that's when you've had your huge sort of sell-offs back up. Then you had a 5% bounce, didn't last much longer, and then the selling coming again. So this is on Wall Street. So Wall Street, Nasdaq, US 500, S&P 500, all got these conditions on. But one thing he's saying is, when you do have these bounces here, and they are quite extreme, but generally your overall trend is down. Yeah, and we don't know how much further it's going to go. I mean, you got FTSE again back on the lows at the moment, so it's yeah, it's really, really, really yeah, really under pressure. So that's one thing to consider when you're trading. If you are you are on the sort of bounce as well. You've got to be on top of it in case you do see it start pushing against your sort of entries and things like that, because it goes against you. Like I said, you could it's really is a case of managing position, using your stops correctly to exit. But bounces are going very fast, very quick. Sometimes just take a little bit of patience for it to really materialize. But what goes up tends to come down. What we notice, well, what traders will particularly be looking for are previous lows and highs. So going back in time and having a look at sort of weekly lows, ones where there's a period of 4, 5, 6. It really is, that's where you're getting your bounces too. I mean, you looked at these ones here and you could have thought, yeah, definitely we'll have a little bit of reaction. Then intraday you did actually get sort of reactions, but once they go, they start really going, and we start getting into this zone now. Touch a little bit lower now, so it really is, going back in time, having a look at your daily lows, and then even taking your time frames down now. So if you are intraday trading, you are following out throughout the day, you're going down to even your 3 minutes, your 5, your 30, your 4 hours, just looking at, where we've had a lot of candle lows, a lot of sort of nearly confirmed sort of support, because we're seeing it sort of bounce up and coming back to those candle lows, testing the support again and seeing another bounce up, and even with the resistance well back up there, you're seeing sort of where it is on the shorter time frames. It's coming out, it's coming and testing them again. You maybe a little small break, but then that's just encouraging more selling, and it's just coming off and off and off. But one thing when I was on the bounce as well, one thing interesting is a particular tool that you can use is the Fibonacci tool. And what that Fibonacci tool does, it kind of measures the bounce, where it measures bounce, and it gives you sort of preset percentage levels of where you can where sort of bounces could go. So like this, we say if we were trading up now, so we had a little bounce up there, so we come all the way down, that we had the bounce. I'm not sure what that is. Bounce up, then we start getting these Fibonacci levels. We start bouncing coming up, and it's actually the other way around there. We could put a Fibonacci there, and we can start working out where the fib levels are. So as you can see, that's 30, 28 the other way around. So 38, 50, and that's what we're seeing. We're seeing sort of bounces down, and we're seeing reactions off the Fibonacci's, and you can start to see, okay, if it's bouncing off of 30, we are seeing, you'll be seeing that's a bit more of a stronger trend. We go 30 to the 50 to 60, and okay, are we seeing possibly more of a strong pullback? As I said earlier, someone's saying, I mean, technicals are being blown out of the water, but if you're seeing a super strong move, yeah, your technicals are blown out of the water with these strong moves. But when you're seeing sort of sell-offs as well, and there is sometimes you do see a bit of calm in the storm sometimes, and you do get your fibs on. You are seeing reactions from those fibs. You are seeing 38 to 50, especially if it's lining up with previous candles which had resistance, or maybe in the past there's a big sort of level as well. That's them sort of levels that coincide with each other. So that's what traders will be looking for, those sort of confirmations of particular levels. I'll do a bit of technicals at the end. Okay, let me get through the slides and we'll fit in like quick 5 minutes of technicals. But you can see like these fib here. So come all the way down, it's bounced all the way up. Do note that fibs go from the low high to the low, or low to the high. Yeah. Okay, so here you wouldn't draw a fib to here to there because it didn't actually make a new high there. So this is still the valid high, and it actually come all the way down. It went through the 23, went through the 38, so went through the 50, but just stopped below the 60 there. Okay, you can see a few sort of candles of support, but before there as well. So it wasn't the most ideal one, but it gave you a bit of a bounce there. So and if it got back down there again, you still be pretty valid around there because that 60 has not been breached. Okay, and that's how you use your Fibonacci's, and we'll try and get some on now as well. But they seem to be a very popular tool. It's your bigger ones as well. So you're going, if you get your weekly charts out, things like that, you are be able to, and not there. I can't really see too many valid fibs on the weekly or the monthlies at the moment because of what's happened. But you do get them on you, and you do have these sort of moves where we are taking away sort of recent, we were able to see possible sort of resistance levels. Let me get the risk. We're going to risk management and a bit of an oil drop, and I'll get some quick fibs on the live charts. But yeah, risk management is still number key, even in these markets moving so quickly. You've got to just take that into consideration. Are you going to lower your sort of your volume to match the volatility because of just how quickly it can move one way or the other? So you just need to understand it can move very quickly in one way or the other. Volatility is going to continue for some time. Do you want to miss out on future opportunities now just because you jumped in on something, you lost your temper, or you had a good bit of money and then you're giving it all back and you thought, oh wait a minute, I'll just try and get that back? Are you prepared to take that, or are you really going to take a look? Okay, there's opportunity after opportunity at the moment. Let's take it nice each one as they come, and really stay on top of that and really stay on top of that downside. Markets gapping up and down, that's just the normality when we are in these sort of conditions. They say a lot of gaps, okay, they really do. So gaps like to be filled, but also if you're on that first gap that left in Wall Street when we had that those few days, it was back on it was a week after my birthday, so 7th, about around the 14th, I think it was in that week then. Throughout that week there, it was you had that one gap there, that was the one that triggered everything, I think. So that was one that a lot of traders were waiting to sell, a lot of short sellers were waiting to get onto, and they got it there. Yeah, make sure your accounts are sufficiently capitalized if you want positions to be effective. If you don't want positions to be, I just want to say if you don't. Okay, if you don't, because major close, you know how it works, 50%, yeah, and it can come very quickly. It can just flick behind there, and that's when positions are closed out. So if you want, if you feel you're in a long-term position as well, maybe you want to tie up capital there. Maybe trading the future there because you think, okay, it's got to turn around. Then you'll be looking at, make sure accounts are sufficient capital and keeping an eye on that margin percentage rate. Okay. Quickly as well, oil drop as well. We've got a lot of oil traders, they seem to be huge as well. Oil's off 60% since Jan's highs as well. A lot of it's to do with coronavirus as well. I mean, airlines, general transportation is grinding to a halt. Also though, OPEC were unable to agree a substantial cut with Russia, and Saudi Arabia announced a price cut per a barrel, which is a price war, really, isn't it? They took off what, $10, I think, was it? $10. They really, they go toe to toe. This is devastating for Venezuela, Iran, Iraq, places like that. Even the US as well. They're not too happy. They weren't too happy with a high oil price, but I don't think they're too happy with it down this low as well. Competing against their shale industry. All major oil benchmarks are seeing huge losses. So then again, that's what you want to be looking at. You want to be looking at those markets which are moving, extremely. So you're looking at FX now because everyone's running to the dollar. You're looking at your oil because could this go any lower? I think it certainly could. It's just, especially as we start to see sort of the impact of the airline industry and things like that. And indices are your number one traded market at the moment because of just how much they're coming off. So let's just quickly just take a look, sort of a bit more on the Fibonacci's. I'm just waiting for my platform to load up. Okay, should see it now. There it is. So say we are trading sort of Germany 30 at the moment. Look at that huge drop. When we do start to see eventually a low sort of occurred, we start to see bounce backs, then that's when you can have your Fibonacci's on there. But say that is the low there. Is these sort of levels we'll be watching out for, aren't we? I mean, I feel like I'm talking so much in the future when I do, but it's always good to have your prep for these sort of levels and these sort of areas of breakdowns. You know, where they sort of broke down there. You know, 61% if it got up there, is that going to have an area? And that 38.2% there. These are sort of target sort of levels. If you are even as a as someone who's trying to get in on a sell-off to keep up with the direction there. You know, if we start to see moves up to those 23 or 38, that's when you can guarantee, well, you know, there's going to be sellers around those scenes to try and keep that from going any higher. You know, it's just all about the balls then to try and push that a little bit higher through those levels. But then, you know, you're taking it down to even more smaller time frames. So if you take it down to sort of your 30-minute there, and you can look at sort of previous sort of swings here. Right click, clear up the charts a bit, delete all drawings. Up here, Fibonacci tool, we can see this sort of swing here. Yeah, well, that's broken out now, isn't it? So we see that if we start seeing moves up there, we can start to see like sort of previous sort of areas that we can see coincide with candles there. You can see that this resistance here, that's on the 23. This sort of move up here, that sort of fiddles in with the 50% there, doesn't it? So, you know, they're sort of coinciding with levels there. It's always good to go back to sort of previous sort of candles, look at those highs there, because that's where the sellers are coming in. You know, you can see the footprint, having a look there, where there is, and we've seen that gap down there as well. It's just, you know, and you'll be redrawing these fibs, and these, as they start to break up through these sort of zones there, you're going to be taking it to different time zones, bigger time frames, shorter time zones, to really start to pick out those levels, where those resistance, where those support and resistance are going to be. Yeah, it's just, yeah, it's just it's been a huge sell-off there, wasn't it? These are the gaps up there I was talking about there. It was then. Nope, it wasn't then, sorry. I'll have to fish that date out for you guys. I'm coming towards the end of the session here now, guys. It was a 45 minutes. I said I'll let everyone get back to the charts. So if you just bear with me. There we go. Rabbit on quite a bit then, but if you can get an understanding of someone who's been doing this for many years, just how, I mean, it's a very bad situation. Everyone's very worried, you know, what's going on there and what the measures are. So we can only hope that, you know, they can all sort of, you know, get back on course and you know, things start to get better. But it is what it is as traders. You know, the markets are doing what they're doing. It's you know, it's a lot of stuff going on there, a lot of technicals, a lot of ways, a lot of fundamentals, a lot of listening to the news and just getting an idea really of when this may bounce back or start to push back. But short, sweet, let you get back to it. Any questions I'll be happy to take. Anything whatsoever you feel like, if I don't answer you now, I've got the question noted, and I'll be happy to get back to you. Yeah, man, we asked about spreads there. Spreads are just the underlying market. You know, the underlying market is very volatile. You know, these markets do track the underlying market. So it's you still got a few markets there which our spreads are getting tight. We did start to bring the DAX back in today, and it's something we're looking at in a continuous moment. But look, they're still moving hugely. The market's still moving hugely for you so at the moment, and there's going to be plenty more opportunities. It's like I said, it's a volatile market at the moment. It's if you trade volatility, there's a lot going on. So yeah, look, just keep an eye on things. Keep a look at the markets. FX markets is still very tight as well, and your FTSE is still it's still very tight as well. So keep an eye on that. Okay. Farah, if you can drop us an email on that, I'll be happy to take a look at that. No problem. You can drop me an email, michael.baker@etxcapital.com. Someone, yeah, well, it's michael.baker@etxcapital.com. That goes straight through to myself. Okay. Feel free to use me for anything, guys. It's fine. I'm on. if I'm not on my desk, I'm working through my home office. So I'll be picking up all the time. But look, thanks guys. Quite a very busy webinar, a very good turnout, and I expected that because of what's going on. But look, we could be having these sort of markets for the foreseeable future. So just understand that it's so much going on. Make sure you've got the you've got the account to trade these opportunities, and you've got the discipline, and you're using the technicals right, using the fundamentals right, and you're sticking to the right markets. And if you are trading stuff that's long term, do think to yourself, okay, that's locking me out of the market at the moment. So and if I'm doing things that damage my confidence or damage the account, then they're also locking me out. So plenty of stuff going on. Just watch that risk, because as the downside can be quite extreme, as you can see, especially with 1200, 600, 1600 point ranges each day. Just keep on top of things, and yeah, we're gonna have another update soon in a couple of weeks time. Let's see how things have progressed from there. But thanks for coming along. I hope you enjoyed it, and I will catch up with you all very soon. Thank you very much. Have a pleasant evening.